change. Now, the Reserve Bank of India has issued draft norms to regulate dividends and profit remittances by financial institutions. Ritu is joining in with more details on this. Ritu.
Well, the RBI has proposed to cap the dividend payout by banks at 75% of their net profit, subject to them meeting the eligibility conditions. And this is for all commercial banks, including State Bank of India and also the foreign banks that operate in India through their branches. For regional rural banks and local area banks, the cap is slightly higher at 80%. Now, earlier, the dividend payout by banks was effectively capped at 40%. So this is an easing of that cap, so to speak, but it comes with certain riders. So the 75% cap is tighter for banks that have a lower tier 1 ratio, but liberal for banks with a higher tier 1 capital. Extraordinary or one-off profits also cannot be used to boost dividends. And RBI has also clearly defined that the adjusted PAT that you will use to calculate the dividend payout is going to be the profit of the year minus the net NPAs as of the 31st of March. And when RBI says dividend, it means the equity share dividends, and that includes the interim dividends but excludes the perpetual non-cumulative preference shares. Now, boards are also being asked to look beyond just profits when they're deciding on this. They have to factor in NPA divergences, if any, the auditor's remarks, the capital buffers, and of course, the long-term growth plans before they approve any dividend. For foreign bank branches, there's some relief because if they meet the eligibility norms, they can remit the net profits from their Indian operations without any prior RBI approval. But, if there's any excess remittance that is found after the audit, it'll have to be returned by the head office. Finally, the eligibility is going to be important because the capital must stay above the regulatory minimum even after giving out the dividend, or you cannot, dole it out. Banks must also, of course, be reporting positive profits, and there should be no restrictions from RBI or any other authority. So net, more headroom for dividend payout depending on the capital buffers of the banks. But this is still a draft paper. Comments have been invited by early Feb, and the directions will only become effective from the new financial year, that is FY27.
Ritu, thank you for that update there.